Hello, my name is Benjamin Tan, and I'm the Securities and Education Course, i.e. the SEC co-lead lecturer. SEC is student-led course run by the Investment Society, and welcome to the SEC Winter Special, which is the 20-minute condensed bite-sized version of the lecture for you to brush up on your knowledge in the winter holiday.
Hello, my name is Sebastian Stewart, and I'm the co-lead lecturer along with Ben. The SEC is a finance lecture series based on the CFA Level 1, covering a range of topics ranging from equities to real estate to FX and many more. This lecture series is ideal for beginners as well as advanced and intermediate students. We hope you enjoy listening to the podcast as much as we enjoyed delivering the lectures. Thank you for all those who attended the course this year. We had a record level of registration and hope to welcome more of you next year.
Hey guys, I'm Lassen and I'm a current fourth year aeronautical engineering student at Imperial. In terms of past experiences, I spent a spring week at Morgan Stanley and then a summer at the real estate division within Ares Management, and I'll be giving you guys the accounting lecture as part of the SEC series. So starting with accounting, I know it's not the most interesting topic, but I think it's very important given how companies use accounting to report their financial statements. So what is accounting? Accounting is just a standard set of rules for recording financial transactions, and it's used by all parts of society, whether that be individuals to keep track of spending and savings, businesses to record their costs and revenues, or governments to monitor tax collection and expenditure. Now, when we mean by accounting, there's usually a standard set of ways these are reported. That could be the income statement, the balance sheet, and the cash flow statement. And these are typically reported quarterly for the CFO to use, as well as people outside the company, such as investors, tax authorities, and financial regulation bodies. The way these statements are recorded are generally called Generally Accepted Accounting Principles. Now, this standard varies by region, whether that be UK GAAP or FRS, as well as US GAAP for US-based companies. IFRS is the International Financial Reporting Standards, and these are much more widespread, and this is adopted by over 100 countries. Accounting can be split into two types. Firstly, there's cash accounting. So moving on to cash-based accounting. Cash-based accounting is when you record the transaction based on when the cash was moved for said transaction. This is the most simple and straightforward way to track your finances, and this is how the finances are tracked on your bank account, for instance. Moving on to an example. Let's say a firm called QT Auto is recording its books using cash-based accounting. Let's say on the 15th of January they sell 2 trucks, but only receive payment for that on the 20th of January. Based on cash-based accounting, you would record this transaction on the 20th of January, even though you technically made the sale on the 15th. Now moving on to accrual-based accounting. This is the form of accounting that's used by all corporations, as well as what's mandated by US or UK GAAP. You record the transaction, the inflow or outflow of money, based on when the transaction happened, not when you receive the money. So if we look at an example, suppose that QT Auto sold those same 2 cars on the 15th of January. You would record the transaction in your books on the 15th, even though you may only receive the payment on the 20th of January. Now this change is called accrual accounting, and you accrue these activities when they happen, not just when you receive payments. There's different advantages and disadvantages for each type. If we look at cash-based accounting, you physically cannot go into debt because this would show up as a negative on your accounts very quickly, and so it can be easier to track the movements of cash. However, this could be more difficult and slower to grow a business, as you may only receive payments for some of your activities a year from when you actually made the transaction, and so it can't be a very good indicator as to how productive a business is. Moving on to accrual-based accounting, the advantages are that it's more reflective of what can happen on a day-to-day basis. It's easier to track business activities. However, on the flip side, it can add a lot of complexity, as tracking these firms' activities across geographies as well as timescales can be difficult. It also enables the firm to act on credit, which could be dangerous if it's not done correctly. So moving on to the 3 statements. This is the method which companies use to report their financial activity. The first one being the income statement, sometimes referred to as the profit and loss statement. This statement is critical to the operations of the company, as most of the time its goal would be to maximize profit. Now, this isn't the only goal of a company, but typically profit maximization is. So moving on to the three statements. These are the income statement, the balance sheet, and the cash flow statement. Let's move on to an example income statement. Starting off, we have revenue, or sales. Then we subtract costs of goods sold to get to gross profit. Then we subtract operating expenses such as SG&A and R&D to get to EBIT. Lastly, we subtract the interest expense and then taxes to arrive at net income. Now, this is a very basic income statement, and you can add lines in depending on the complexity of a company. But these are the core lines which you'll see on most firms. Moving on to the balance sheet. The balance sheet is based off the accounting equation where total assets equals total liabilities plus shareholder equity. Now, an asset is a resource with economic value that an individual or corporation or country owns or controls with the expectation that it will provide a future benefit. Assets can be split into current assets, which are assets which will be consumed or converted within 1 year, as well as fixed or non-current assets, which are much longer term, with a typical life expectancy of over 1 year. PP&E, or property, plant and equipment, makes up the largest portion of this class. You also have financial assets, which are investments in assets and securities of other institutions, or stocks, sovereign and corporate bonds, or preferred equity as well. You can also have intangible assets, which have no physical presence, but still are an economic resource. These could be things such as patents, trademarks, or copyrights. The next part of the balance sheet is liabilities, which can equally be split into current and non-current liabilities, with current liabilities expected to be concluded within 12 months or less, or non-current liabilities, which have a greater period of time, longer than 1 year. You would have things such as income taxes payable or unearned revenue in this section of the balance sheet. Finally, you have shareholder equity, which is the total amount of money that would be returned to shareholders if all the assets were liquidated and the company's liabilities were paid for. This is where the accounting equation comes in, as the total shareholder equity is equal to the total assets minus total liabilities. The balance sheet is simply the consolidation of each of these portions into one financial statement, and usually reflects a snapshot of a company's position as assets, liabilities, and shareholder equity. Finally, we have the cash flow statement. As implied, the cash flow statement records the flow of cash in and out of a company across a period of time. This is typically a year. More importantly, if we look at the sources of these can be cash inflows, which are cash being generated, or cash outflows, which are cash being spent to finance the operations of a company. A cash flow statement is divided into three main areas, where you have operating activities, financing activities, and investing activities. So if we look at basic financial statement for the cash flows, the operating cash flows would consist of net earnings, depreciation and amortization, which can be summed to get net cash from operations. Next, we have investing cash flow, which could be income generated from property investments or purchase of shares of a company. Finally, we have financing cash flow, which is cash flow which comes from, for instance, the repayment of debt or equity. Finally, you can measure the total closing cash balance, which is summed typically across a year. Now, the operating cash flow records the movement of cash relating to business activities, and this is the main component of the cash flow statement. It typically consists of net income plus D&A, take away your net working capital. Now, depreciation can be split into depreciation and amortization. Depreciation reflects the markdown of tangible assets, whereas amortization reflects the markdown of intangible assets. Investing cash flow is cash flow that has been made or spent on investments. For instance, this could be outflows of money on purchasing an investment, such as a stock in another company, or inflows that could be a result of this investment generating returns. Finally, the financing cash flow section is cash flow that's related to financing the business operations. The two main sections are debt and equity, where debt refers to cash flows as a result of raising debt or taking loans, whereas equity refers to financing that's generated through selling shares of a company. So that rounds out the three financial statements. However, all three statements are highly linked. This is because any values from the income statement, for instance, can lead to changes in values on the cash flow statement, which can then lead to some values being changed on the balance sheet. If we take an example, the bottom line or net income of the income statement is the amount of income you generated for that period. Now this value should also be replicated in the cash flow statement in the form of cash from operations. You would also note that depreciation and amortization is added back in the cash flow statement since it reflects a non-cash expense. If we delve into this further, net income could also lead to an increase in retained earnings on the balance sheet, going from balance sheet in financial year 1 to balance sheet in financial year 2. These two can be linked via the cash flow statement, which records how cash changes across the first year. Lastly, the cash on the balance sheet should be equal to the cash from the previous period's balance sheet, plus any changes on the cash flow statement. It's very useful to know these links between financial statements, and it can also be used to check discrepancies between other company statements, but also financial documents you might have to formulate. A typical interview question, for instance, could ask you to explain how all of these statements link together, or explain how a depreciation could affect all three statements. So how can you put this into practice? One common struggle when trying to evaluate this data is how to actually obtain it. Not only does the data need to be accurate, but it also needs to be in a format where it can be easily used or manipulated. Therefore, if you do want to try out some of these concepts, you can visit Yahoo Finance or Capital IQ and download the financial statements of public companies. This can give you an idea of how the companies lay out their statements, as well as the performance of the companies across a period of time. Next, we'll look at enterprise value. Enterprise value measures the value of a business by considering its operational spend. Enterprise value is equal to the market cap plus the total debt, take away any cash. Enterprise value also measures the amount of money to buy out an entire company. Market capitalization is the total value the market gives for a business's equity. It can be found out by multiplying the share price by the number of shares issued. A business's accountants may overvalue the shareholders' equity, but markets may undervalue this business, so the market value measures the equity portion of this. Another measure which can be taken from the accounting statements is the weighted average cost of capital, or WACC for short. The WACC is used in many forms of financial analysis, such as the discounted cash flow model, which will be explored in future episodes. The two main ways a company can raise capital would be selling shares in the form of equity or to take out a loan, such as debt. Both equity and debt have a cost associated with them, and this all sums up to the cost of capital. So looking into the formula for the weighted average cost of capital. Firstly, we need to look at the weights, which is the weights which come from the equity portion and the debt portion. Firstly, the equity portion comes from the market cap, and the debt portion comes from the total debt which can be found on the balance sheet of the company. Summing these together and multiplying it by the respective amount of equity and debt, you can work out the weightings of each. For the cost of equity, we'll look at the capital asset pricing model, which takes into account the risk-free rate, typically taken as the bond rate, as this is the rate at which investors consider very low risk of default. You also take the beta, which is the volatility of the stock, and then the market rate, which is the typical rate you can get by investing in public equities. The formula itself, which can be found online, can be used to work out the cost of equity. Secondly, looking at the cost of debt, this can be worked out from the company's statements by taking their interest expense and dividing it by the total debt. Now, it also needs to be considered that debt is considered a tax shield item, since it sits above the income before tax line on the income statement. Therefore, we multiply by 1 minus the tax rate for the debt portion, and by summing these together, you can get the weighted average cost of capital. Okay, so that rounds out our whistle-stop tour on accounting. For more information, please do look out for the SEC lectures from the Imperial College Investment Society, as well as Investopedia, which can be helpful when preparing for interviews. If you guys want to connect on LinkedIn, it would be great to hear about your experiences. You can find me at Lassen Wani Arachige, and this will be also in the link description in the show notes. Thank you all for joining me, and I hope to see you in the real estate lecture.
Credit to our producers, Aaliyah Friedman, Louis Kim. Head of Marketing, Samhat Raman. Juniors, Ken Zhang, Angie Zhao. Head of Scriptwriting, Alfred Choi. Juniors, Aditya Mutha Kumar, Kwan Lin. Head Liaison, Lucrezia Poloni. Junior, Ekaterina Vitor. Head of Audio, Isaac Chu. Junior, Cyrus Lee. Head of Sponsorship, Sami Liu and Vladimir Dmitriev. Juniors, Leo Lee, Jamila Tabet, Utkarsh Jetli.